Welcome to the Purpose-Focused Advisor, a podcast for financial planners, advisors, and RIAs looking to get the most out of yourself and your business. Join Rob Brown as he walks you through a journey that will allow you to take action in your business and your life so you can be the best that you can possibly be. Now here's your host, Rob.
Welcome back. Time once again for the Purpose-Focused Advisor. Rob Brown here, along with my guest today, Gary Sinderbrand. And it's a hard name for me to say. I'm not sure why, but I'm probably not the first person that said that. But Gary is a veteran of this industry. He has been a very successful producer. He has done an incredible job of training other advisors. And right now he is the leader of Better Path Training. So Gary, welcome to the show.
Thanks, Rob. And I appreciate the care you took with my name. I think the record for mispronunciation was someone broke it up into two names, Mr. Cinder Bunny. So first name Cinder, last name Bunny. So I'll take Sinderbrand all as one long name.
Yeah.
Nice to be with you.
Yeah. I just got to say it slowly. It's actually not hard to pronounce. It's just, if you don't use it a lot like you do, you have to say it more slowly. Well, Gary, I love for you, before we get into our discussion today and really talking about what's going on in this kind of dance between senior advisors and junior advisors and what needs to happen to move the business industry and the business forward, I'd love for you to give the audience a little bit of your background because it is unique, and your story really helps impact the influence and the credibility that you have in leading advisors to new levels of achievement.
Sure. Thanks, Rob. I think when I was hired by Merrill Lynch, excuse me, in the early 80s, I can't decide if I passed all their tests or I was the only person to show up for the job. I had to go through 6 interviews, one of which included a 4-hour interview with an industrial psychologist in New York City. When I asked this woman, her name was Sarah Marks, I remember it well, do you need to be crazy to want this job? And she kind of looked at me sideways. She goes, not really, but it kind of helps. And I'm like, what? And they were very realistic. I had a 95% chance of failure. I finally got the job. The manager, when he hired me, said, I still think you're too young, but let's give it a shot. But I don't think you're going to make it. So that was my hiring. I spent my first year basically seeing if by the end of the year I could have my production and my assets under management tie. So I produced, I think, $105,000 in my first 12 months. I think that's where my assets were as well. I didn't make anybody any money. I blew my book up. Most of my father's friends, who were also smart enough not to give me a whole lot of money to mess with. I did that using some very unique option strategies, selling naked puts and calls on stocks that would rarely move and supposedly just keep the premiums. I discovered one of my unique talents. I could pick out a stock that while it might lay on its back for years, it seems like the week I would put a position on, it would go into atrial fibrillation. Something about Polaroid at $15 forever. Then the Hunt brothers messing with the silver market. How did I know silver oxide was used in Polaroid film? So that didn't work out real well. By my second year, I just stopped listening to people from the firm and I started asking people what they were concerned about when they put their money to work. Interest rates were quite high at the time. Money market rates were just coming to be available. Banks were paying 5. The Merrill Lynch cash management account was paying 15. So it was dialing for dollars. A lot of referrals, very few cold calls. Began networking that year as well. Went through about $380,000 in my second year and starting to build a good book. My manager came to me at the end of that year and asked me for half my book. And I thought he was crazy. It turns out he wasn't. Because I was getting better and opening larger accounts, I made sure that a lot of accounts I'd opened in my first 2 years were placed with other account executives that could care for them. And basically keeping my book under 125 households. My third year, I did about 680. Fourth year, about 850, about 860, a little bit more my fifth, and then went through $1 million in my sixth year and just didn't look back. I was in Princeton at a meeting, and one of the executive vice presidents approached me and basically kind of put things in perspective. She congratulated me on my production, my ranking in my class, and so on. She said, I noticed you're not doing the things that we trained you to do or we're promoting. I wasn't buying individual stocks with Merrill Lynch recommendations on them. Basically, I wasn't buying a lot of packaged product. I was trying to solve problems. But I was also moving into much more of an annuitized or fee-based business. Back then, we did have some managed money opportunities, but we had a lot of C shares also. And I realized that if I could take the pressure off of a client, we even called them customers back then, that when the phone rang, they wouldn't have to make a decision. It would cut out a lot of issues from the client's perspective as to whether or not I was calling because I needed to pay my light bill or I was calling because I really wanted to help them get to their goal. That was at the forefront of Merrill Lynch moving into financial planning. I was asked whether or not I could put together a training program to teach colleagues what I was doing. I'd done some speaking around the district and had no problem being in front of a crowd. So I got together with another FA who was following the same path, a guy named Bob Payne, and we decided if we're going to do it, we have to do it right. So we told them we need 2 full days. We need them off-site. We need a follow-up in 30 days in smaller groups, and we need a 1-hour coaching call. Figured Merrill would never go for that. Well, they did. They decided to launch a pilot. The first 50 people they brought in, I think they said they would be midline producers. I think most of them outproduced both Bob and I at the time. They were extremely senior, which means they were cynical. They didn't like being out of their office. And we put them in Princeton for 2 full days. Seemed to go well, but we didn't know. 30 days later, we went through to Chicago, I believe, Atlanta, and maybe New York to do follow-ups in smaller groups. First follow-up was in Chicago. We were expecting 17 or 18 people. At 5 minutes of 12, there were 2 people there. At 12:15, there were 23 people there. Other FAs showed up, wanted to know what all the fuss was about. And we sat there and heard story after story from these very senior advisors who had found new assets from current clients, who had moved to an annuitized business, who had started a segment, everything we had talked about. We were kind of blown away. 3 months later, we got the results of the pilot. It was done, the assessment was done actually by James Gorman, who eventually took over Morgan Stanley. He was the McKinsey consultant that did it. And the report basically said, I don't know where you found these guys, but they're doing everything that the firm wants to do. And the people they're talking to are doing it in higher numbers than a control group McKinsey had set up to study of similar people. And that kept us on the road for 12 years. Payne and I never named the program. It became known as the Payne Sinderbrand program. We probably trained, over 10,000 advisors at Merrill. Many of them came through multiple times. And it was wonderful. It was, we were still in production, so our credibility was there. But seeing the lights go on in somebody's eyes that doesn't believe anything from anybody, as an FA, good FA should, we should be skeptical. It was pretty amazing. Made a lot of good friends, helped a lot of people. A lot of my clients today are FAs I trained 30 years ago who credit me with their success, which I call complete BS on. Because my comment is, look, we showed up, we talked for a couple of days, we had a nice time, but you did the work. It was your choice to do the work, and I'm glad it worked out for you. If we could point out the way we did it or learn from others, and you decided to use it, this means you're smart. So I kind of work still in that realm today. I've left production, but I still value as much as ever the relationships I've had with a lot of FAs I trained previously, but a lot of them I'm working with for the first time, especially some of the younger guys.
Yeah, but before we jump into that, I want to make sure I stop and point to a couple of things, because for some advisors who are listening to this podcast, they may not have the history, Gary, that you and I have in the industry. We've both been at it a long, long time. But something that there are three things that you said that I think are important to point out. You were quick to go through that $1 million mark, and that $1 million mark back then was, I don't know what it is in today's dollars, but it's a lot more. But there was a quick ascension to a very high level of generating business, and you were early in the recurring revenue, the annuitized business, which I think I run to some younger advisors today and they feel like, hey, it was always this way. And they'll say disparaging things about advisors who may have been stockbrokers or laddered bond portfolios and took points. Well, that was the only way to do it for a good period of time. But then thirdly, and most importantly, you were early in the planning game. And it didn't matter if it was Merrill Lynch deciding to put financial planning on the platform. It was more, I sense you realized that planning needed to come before product. And so I think those three things will really help inform the rest of our conversation. Gary, I'm going to read something here. I asked the question in preparation for this. I have a little questionnaire that I send the guests, and I said, what would you like to share with the audience? And the first thing that you answered was, I'd like to share a fundamental insight that's driven your career. True success in financial advising isn't just about managing wealth. It's about developing the soft skills to convert prospects into lifelong clients and friends. I love that because the name of this podcast is the Purpose Focused Advisor Podcast. And I can't think of a purpose much better, or maybe everybody's purpose is good. So I shouldn't rank them, but to be able to say, to convert prospects into lifelong clients and friends, that's a purpose to go after. Talk a little bit about that, Gary.
Sure. Among my various epiphanies between my second and third year, I realized that driving to work one day and looking around at all the other people that were on their way to wherever they were going on a Monday morning, I tried to think of how many of them had a job that could be described as choose your own hours, work with who you want to work with, make an unlimited amount of capital, and always leave it better than you found it. And I realized what a unique position this was in. And not to respect the privilege I'd been given by, A, securing a job at Merrill, and Merrill was still Merrill back then, and B, having the opportunity to make people's lives better, gave me a real tight mission focus. I also realized that I didn't want individuals on my book that I would consistently have to sell to. So the process that I came up with in conjunction with Payne pretty early used an extraordinarily old piece of technology. I mean, we had Quotrons back there, Rob, if you
I remember Quotrons, yeah.
Yeah, it wasn't exactly computing horsepower. And
hey, let me stop you for a second, because I want to put Quotron, the way that I put the Quotrons or the quote machines that we use to get quotes in perspective is they generally displayed like 3, 6, or 9 stocks or indices at a time, and to add another line which had 3 or 4 more stocks or indices cost about $1,000 a month.
You are correct.
A month for just 3 little, just to stay live with them. And we
You're
think
right.
today about just, the information that we can get on our cell phone. It's crazy.
It's pretty wild. If you want a Bloomberg, you had to mortgage your house to get one of those.
You get a Bloomberg, how much are you producing, and are you willing to, anyway.
So this program that was embedded in the main system was referred to as Retirement Builder. And no one was really using it. But in Retirement Builder, you could put in a expected rate of return. You could put in an inflation rate, a tax rate. You could put in some cash flow inputs and some extractions. And you could also basically forecast in the future what the number would be adjusted for inflation. So maybe 8 or 9 inputs. Think of it as a prehistoric version of something like Money Guide Pro. So we figured out how to hack it in a good way to get it to do what we wanted. And we said, okay, if we're talking to a prospect or a client and we know everything that's going on with them presently, all of their investments, which would give us, by the way, complete justification to ask for everything, because we were very, very clear in setting our expectations. Just to digress a bit, early on, we realized the importance of displaying value as early as possible. A lot of people have a value proposition. How can I propose something to you that you've never experienced? So the first transaction that would occur would be educational in nature. And we came up with this concept of making what we call an investment introduction. 12 to 15 charts we would pull from Ibbotson or from Merrill's library, explaining the markets, explaining what a bond is, explaining why bond funds don't work, explaining how equities outperform, but they don't do it every year. All basic stuff that every advisor knows, but I would do it in a very, very disciplined fashion. And the client would keep the chart book and they'd make notes on it. One of the things we really believed in was we need a full understanding of what this goal looks like. So we'd start at point A. Point B is where you're either capitalizing or you don't need the money anymore. And we would factor in everything we knew between the two in the middle. Time would pass, money would go in, money would go out. A lot of things we knew. We had some known unknowns, which we had to take into account. And essentially, it would default to a rate of return. And we'd have to keep running it. Let's try a 5%, 7%, 8% rate of return. And we had to wait for the dot matrix printout to see how it all worked out. That gave us, let's say, a target rate of return for someone, in some case, let's say it was 6.5%. So we would then come back and say, okay, over the longest term, equities average 8%. Bonds around 4, inflation around 2. So if we need something in the 6s, that probably sounds like about a 50 to 55% equity allocation. And, the balance probably in bonds and a little bit in cash. And the client would go, well, I don't want any risk. Can't we just do treasury notes? And I would say, well, yeah, but they're paying 3%, so you won't have any risk. You'll run out of money. That'll be a certainty. And then I would explain we've got a 30-year time horizon. At a 5-year time horizon, equities outperform 80% of the time, 10 years, 90%. There's never been a period over 30 years. So we're going to exchange that uncertainty for time. And the more time we have, the uncertainty shrinks. I'd also explain that markets move. So the only time this plan or forecast is valid is right now. So let's say 2 years from now, equities have had a great run and your 55% is now 70% and bonds are now 25 or 30%. Oh, that's great. That's great. And I would look at him and say, no, that's not. What I'm going to do prior to that is recompute based on higher numbers. Maybe we don't need 6.5% anymore. Maybe 5.5% will get us there. And if clients push back, I would say, look at page 14 in that chart book and look at how asset allocation drives the majority of return. And I would tell them when they would onboard, if we have a disagreement, this is where it will be. And by and large, clients cooperated. I had one person leave during the internet boom. He left happily married with $1 million because all his friends were making 30%. He was bumping along at 14. He came back 2 years later with $250,000 and a divorce. I still took him back.
Yeah,
that was the discipline we stayed with. That allowed me to come back and answer your question, not to get a piece of someone's assets, but to get all of them. Because I had to have all of them. And I would just ask the client, well, I've got 2 million here and 1 million here and to give you $500,000. Well, what's going on over here? Well, I've been with them a long time. No, I get that, but we've established what your goals are out here. Can you explain to me how these other 2 brokers are acting to get you where you need to be? A month later, the money would come in.
Yeah.
So that really was a large part of my success. Last part, answer your question, if I didn't like you or I just got a bad vibe, I would tell you you'd be better off someplace else.
Wow. Again, just peeling that back a little bit and just putting the perspective of where I see advisors today as I talk to them. I think one thing that some advisors may take for granted, and I know we did back at the time because I was in there in the trenches at the same time you were, Gary, is sitting down and putting all of that information for clients was often one of the first times they saw all of their financial situation in one place because stuff was scattered. And I think advisors today don't appreciate the fact that the tools that they have to make it easier to pull that together is a real great foundation for taking a relationship forward. And then it also, as you talked about, the relationship that built from making sure that you were on the same page and you didn't take on those clients that you couldn't help. I think those are important things to be thinking about. And again, they really add some credibility to what we want to talk about next. And Gary, I know this is really where you are spending your time. You're spending a lot of time right now. You said in your note to me, you're committed to bridging the skills gap for the next generation advisor. And then you're aiming to expand the way that senior advisors think about succession, because that's changing. And I see this in you as probably being a new purpose and a new passion, because you don't want the industry to lose this system and these ideas that you've helped deliver to other advisors. And I'm like you. The advisors do the work as coaches, as consultants, as trainers. We get to sit back and kind of cheer them on and give them ideas, but you don't want that to end. So talk about why those 2 points are just so important to you.
Sure.
And what you're doing about it.
So after 2008, Rob, as you know, firms pretty much ditched training. Merrill stopped it in 2002. Merrill took all the FAs off the road when Stan O'Neill took over the firm and decided he wanted to make it a trading house instead of a retail house. So training across the board kind of dissolved. Industry suffered, I would say, very little growth in net new advisors after 2008. If you wanted to add to your advisor role, you put a big recruiting deal out there and everyone said, these are terrible, we're not going to do them anymore, and now they're bigger than ever. I think where people just are recently waking up is understanding that gap that occurred in 2008, two things occurred. FAs that came into business at some, let's say 2, 3, 4, 5 years prior to 2008, came in like you and I did. Here's a desk, here's a phone, here's a draw because we have to pay your benefits, but you got to earn it back. Good luck. And the draw wasn't very much. So there was no plan B. You had to find a way to survive, or you'd be part of the 9 out of 10 FAs that would wash out in your first year or two. My approach to that was not to do what everyone else did. What I realized was early on, I was lucky. I got to hang out with some really great producers because I was close. So I had some mentors in Princeton, New York, and Philadelphia, and they seemed to be really chilled out and had great clients. And I found out they never cold called. They built professional networks with attorneys and accountants. I figured I'll do the same thing. And I also pre-programmed clients that I would take on board for referrals because I would tell them that's how I get paid. Yeah, I'm going to get you where you need to go. And I'll get a percentage of that. Each year you'll know what it is, but the best way you can pay me is when I come to you from time to time asking for help to meet other people like you, you'll be there for me. No one ever said no. So that allowed me to really build the book up, but I had to get comfortable doing it. More importantly, I had to internalize the belief, or actually the truth, that people were better off with me than they were anyplace else. Because if I didn't believe that, what right did I have to solicit them? And sometimes it's like you manifest your own destiny or you act as if or whatever it might be, but you become that which you basically present yourself as, and you've got to fill in the blanks, which I was fortunate enough to do. But my book was hard won. It was built from scratch, and it wasn't straight up every year, but it was pretty damn close. The FAs that are coming in today, basically, if you're coming through Merrill, you're sitting down at a desk with a script, and you're calling people from Bank of America on a recorded line, trying to convert them into a retail account that'll pay fees. You have hurdles. If you don't make it, you're fired. Done. Finished. So there's a very narrow band of things that you can do. Mostly at the other houses, when you come in, you have to come in on a team. So a team has to decide, a senior team has to decide to take you on. And I think what corporate thinks at a lot of these firms is, well, they'll bring in these smart junior members who may not have the client development skills, but they have good tech skills, so they can help with planning and they can do this. And I'm thinking to myself, this is nonsense. I can hire someone administratively to run financial plans for me. I can hire someone else to make presentations for me. If you're an FA, to me, that stands for find assets. So if I'm in the office doing busy work, I'm not growing my book and I'm not improving the lot of people I have the ability to help. I didn't like sitting still. I liked being out. I liked hunting, and I liked getting creative around it, and hunting not necessarily for assets or households. I just liked people. I was interested in how this person made their money or how that person built this business from scratch. And there were times I'd go in and just ask them, I'm young in the business, I'm learning, but you've been doing this for a long time and you're in the commercial laundry business. Did you ever think you weren't going to make it? They'll talk to you for an hour. And there's a bonding that takes place, because I also finally realized when you allow other people to tell you their story, they automatically think you're smart. So, okay, I'll take that. That's fine. But think about it. They've told everybody that they know their story. Now they're telling it to you, and you're learning about them. And you're saying, could I drive around town with this individual? Could I drive cross country with this individual? Hey, this is somebody I want to hang out with. And when I got that vibe, you were going to become my client, even if you said no. I would stay with you. I'd prospect you until you told me to get lost, because I liked you and I wanted to help.
Yeah.
So,
and I think at the center of that, and sometimes we forget that, is trust. You were building trust. You weren't trying to grow value by talking about all of the things that you could do for them. You were building trust with them by getting to know them, to appreciate them, to relate to them, so that when the time was right, there was going to be no doubt that they were going to become a client of yours.
That's exactly correct. And you never knew when that was going to be. Sometimes they'd open up immediately. Sometimes it would take some time. But I knew if I could help them, it was up to me to basically be able to convince them of that. And I wouldn't use weird forecasts. I would use math and history. And the more educated my clients were, my prospects were, the more ready, willing, and able they were to introduce me to other people. And that's how the book grew. And that's how the book grew really quickly. The other thing I did was I kept my book small enough in household number that I was able to reach out to every client I had on what I would call non-market or non-economics phone calls. So over the course of the year, we might do 2 check-ins on what the accounts were doing, 1 annual review, 1 check-in throughout, but they probably have 6 or 7 more contacts with me where I would just call and ask them how they were. What's going on? Anything new? How's Kathy getting on in college? How's Mary's business doing? I picked up more referrals on those phone calls than I could possibly count. I didn't call for that purpose. I called to let them know I was thinking about them. If you think about a typical advisor's book, and then I'll come to what I think the gap is in the younger people, typical advisor's book, let's say you have 200 households. You've got to look out on 200 spokes. Each individual household only has one of you. So they look down to the hub and they're hoping those other 199 households don't exist. So my goal was, how do I convince the people that have trusted me with their assets that they are not only important to me, but they're the only client I have? So the more information I had, the more personal it became. The more I was able to go through and truly empathize with what their situations were. With the people that are coming on teams now, the teams I'm working with, not only am I not seeing that, but more importantly, the amount of money that a senior advisor, let's say within 5 to 10 years of retirement, let's say my typical client's producing $3 to $4 million a year, top line, they're taking home a 7-figure number. They've got a variety of people supporting them, and they bring on a successor who's got a CFP. They're in their early 30s. They really want to do it. Their role is to, first of all, to get the job. The advisor's paying them 10 to 15% of gross productivity. So if they're doing $3 million and they're going to pay them $300,000 in production first year at that advisor's grid, well, let's see. I didn't get there until the end of my second year. This FA got there at lunch on his first day. So the motivation kind of comes out. And at that point, that FA is primarily in a support role. They're not coming into meetings. They're not really getting trained because the senior advisor doesn't want to take their time. So they're giving away equity from their own book in the hopes that this person will eventually grow and be able to take over senior FA's book. All sounds great in theory until you realize that the senior advisor's clients are getting older also. And we see about 38 to 40% of the advisors are retiring in the next 5 to 7 years. McKinsey just recently came out with a report. And if you do a little bit of math, that covers close to $15 trillion in assets. And if you then look at the amount of revenue that's up for grabs, it's extraordinary. Add that to the fact that fully 1/3 of current clients will seek a different advisor when their advisor retires. 90% of heirs will change advisors, and there's no connectivity to the next generation of advisors. So I work with that next gen to begin to build books of their own within the senior advisor's book. Senior advisors got 200 households. As you know, there's probably 60 of them generating 80 or 85% of the revenue. And the rest of them, which have probably been on the book for years and years, which were incredibly important when the advisor started, the rest of them don't get called, largely ignored, but they're not in suspended animation. A lot of them inherit. A lot of them have money you don't know about. In fact, all of them do. So I help reconfigure the compensation. So instead of the senior advisor digging into his pocket for no ROI, just a loss of their own book equity, we arrange it so the junior advisor now owns a segment of the book. Usually that segment of the book has a very low ROA. That senior advisor is running $500 million. There's probably $100 million at the bottom doing 20 basis points. And they haven't been talked to forever. So we give the junior advisor an asymmetrical share of that book so they can really grow their own revenue if they choose to. And a piece of it goes back to the senior advisor. And within a year or two, the senior advisor's equity is going up instead of having to dig out of their pocket for no ROI. And frankly, if I were in business today selling my book, unless I could find an advisor that I knew how to continuously replenish it and care for the next generations of families I cared for, they're not an FA. There's something else. Right. Most of the industry is waking up to that at this point.
Yeah, I really think that's a good point. And it doesn't matter if you're talking about somebody inside one of the big houses or you're talking to some of the independent or hybrid advisors. Too often the succession plans look a little bit more like a caretaking plan. Somebody who says, hey, I'll buy into the business or earn my way into the business. And all I really want to do is take care of what you already built. And I really love the emphasis that you're putting into the succession, that that advisor who is the junior, the newer advisor, is being charged with building while they're part of the succession plan, not just waiting back and letting something happen. And that changes the dynamic for both the senior advisor and that succeeding advisor. So talk a little bit about this, what you're hearing from the senior advisors who are maybe for the first time thinking, well, gosh, this succession plan isn't just about giving some of my businesses away. I'm not just, acceding to the industry statistics that says that I need to have somebody, younger on my team. They're seeing that younger person, that newer person, being a value add to the overall process now and into the future.
So it's a huge relief for the senior advisor on a variety of ways. The first thing it does is it takes the pressure off of them to be responsible for that person's development. Do they know how to produce? They absolutely do. Do they know how to train the next generation? Likely the answer to that is no. I've been a pilot most of my life. When I learned how to fly, there were a lot of good pilots out there, but they weren't flight instructors. I'm a good pilot. I wouldn't know the first thing about teaching someone how to become a pilot. Been a good skier all my life. Had no idea how to teach skiing until I started working at Vail in the winter. And it's a journey just to learn how to transit that gap between the two. The issue that you and I went through, which was having the experience to learn from our mistakes, you need to replicate. The younger advisors have to do a stint at the same school you and I and hundreds of thousands of other advisors attended, the school of hard knocks. You got to get beat up. Experience is a tough teacher. The lesson doesn't arrive until after you actually do something, especially if you're smart enough to reflect on what happened. So I can make that happen, and I hold the junior advisors accountable, whether it's for net new assets, increasing productivity from inactive accounts, or a combination of both. They have hurdles, and their compensation shifts over the course of our engagement. And all of a sudden, when they open up their first large account and they keep 75 or 80% of it, it's like they can't believe they just did that. Because for them, over the course of a year or two, they can double their income. From the senior advisor standpoint, maybe they're up 3%, but now you've got someone that is starting to understand the essence of this. And when the senior advisor puts them in a meeting with one of their best clients and longtime friends, and that client's next generation, there's going to be that connectivity, because that younger FA isn't just sitting there, helping them shuffle research reports. They've got the experience of talking to real people and solving real problems. That's the missing link right now. That's the one I work on all the time.
And as you were saying that, what it got me to think about is that it is often said that this space, even in the big houses where the advisors are employees, that this is an entrepreneurial business. And to be an entrepreneur, you have to get knocked down and picked back up over and over and over again. But if we bring younger, newer advisors into our business to be part of our succession plan, and they only see the good because they're just taking a piece off the top, and they're not learning how to build something on their own to live through, as you said, some of that school of hard knocks, we are failing to train them as entrepreneurs. And I think of that just that piece of growing something, knowing that every venture isn't going to go straight to the moon, that there are going to be years where you have some setbacks. And I think that's what you're doing, is you're bridging this gap, Gary, is you're saying, hey, because and I'm kind of getting up my soapbox now. I can feel it coming, but as I've helped advisors over the years build teams, one of my greatest frustrations is the older advisor saying to the younger advisor, I'm not going to compensate you too much because you don't deserve it. And they tamp them down and almost treat them like they'll never get to where they are. So they create this negative space. And then the younger advisors like, well, hey, I know how to do financial planning. I know all of these other things that you don't know or didn't know when you got started in the business. I should be paid as much as you today.
Right.
Today, even though you've been at it 30 years and I've been at it 30 days. And that's a big gap to close. And I think through this discussion, what we've been describing, you're helping close that gap to understand that there are advantages on both ends if you can get on the same page of music and you're working together.
I would agree with you to a certain point, but given the choice between an advisor that understands how to connect with people quickly and grow trust from the first meeting, and someone that passed the CFP exam and can make a computer do what they want, I'll take door number one every time. So will smart clients. Information that you can glean from other sources, whether it's the internet or an AI query, is available, but it doesn't teach empathy. It doesn't teach how to truly give someone the impression that you're going to be there for them forever and there's no stupid questions. I've talked to plenty of CFPs on junior team members on teams who run plans and they're paid well for it. And I ask a simple question because I know what all the tools do. What did you do about adjusting the tax rates on your equity portfolio? And they look at me like, what do you mean? Well, your firm defaults to taxing your equity returns as ordinary income because it anticipates 100% turnover every year. And they look at you like, yeah. Well, that means that it artificially suppresses your equity return, which when you're casting an asset allocation would cause you to take more uncertainty than maybe you need to. Did you ever adjust the turnover rate? I didn't know I could do that. And I'm like, oh my God. So
yeah,
I had that conversation with a private wealth team in California last year, and they were paying the CFP a lot of money. And this senior FA, they were running a couple $2 billion. When he realized, when the CFP confirmed it, he left the meeting realizing that every financial plan he had done for every client was wrong.
Yeah. Yeah.
So having the designation's great, but you've got to be on the case.
Yeah. And I think that we're more on the same page than I may have made in kind of getting on my soapbox, because I use the CFP as a reference, more for just that younger, more aggressive person that just feels like because they are in the seat that they are in, that they don't have to go through some of that school of hard knocks, that their income should somehow equal the senior advisor faster than it should. But I'm glad that we had that little side conversation there, that you made that point, because I think what you talked about is really important. So Gary, it's time to land the plane. We've been going longer than normal, but this has been great conversation. As you think about what you're doing right now, and what we've had a chance to talk about, we can't talk about it all, but is there anything else, any other nugget you'd like to leave with the audience, especially as they're thinking about their succession plans and this need to really build the business for the future, so that the kinds of work that senior advisors are doing for their clients will perpetuate into the future, and really the relationships, as you put, the relationships with the clients will continue?
Yeah, I think there's a couple of things. First, if you're in your, let's call it late 30s to early 50s, and you started and you built your own book, this could not be a better time for you to be an acquirer of other books of business. It doesn't have to be someone really young on a vertical team. You should be looking around to try and make connections, because you'll have the maturity and the skill set to be able to do it. If you're truly on a vertical team and you're a younger advisor, if you really wanted to become an FA, the purpose of it is what I described at the beginning of the call. Go your own way. Become an entrepreneur. Deal with people you want. Control your own income and your own outcome. It's completely up to you what you do with it. If you're just sitting around on a team and you're getting some percentage, and half the things you're doing can be done by an admin, and you're just providing support, maybe you're not in the right job. Because you've got to go out, and your number one goal should be to go out and learn how to find money and solve problems. So as a junior, that's what you need to think about. As a senior advisor, if you are in an arrangement, whether it's family team or someone's been with you for a while, and you're paying them an increasing percentage each year, that doesn't mean you're stuck with that. What it means is you've got a responsibility to your clients that you have currently to perpetuate what you've been doing, and your junior advisor needs to be paid or transition to the same type of payment you had, which is you get to take home what you're successful at, and if you don't do it, you don't get it. So I've worked on ways to transition those plans as well. The thing to keep in mind is this is a job where you have to earn it every day. For someone to come in and know what they're going to make and put FA on their card and they know what they're going to make each year, or you're dependent on someone else, you're not really an FA. You're something else. I don't know what it is, but you shouldn't call yourself a financial advisor. So I think people have to keep that in mind. I think there is a problem that needs to get solved. I think if you're going to bring somebody on board, maybe you should look at 3 or 4 somebodies before you do. Maybe you should give them each 10 inactive accounts and see how they do with it. See who can find more assets. See who can redevelop the profile. See who can begin to demonstrate not just the skill set, but the passion that you need to be able to build a magnificent business that matters. Because if you're in the job, why would you want to be average? So I think that's things people fail to realize. A, how important this role is, and B, just how satisfying it is if you do it right.
Yeah, I love that. I love that. As a fan of the advisors out there who are doing it right, taking care of clients and knowing the impact that can have on their lives, their clients' lives, and it just spreads. It's just an amazing thing. So I really appreciate you sharing that. Gary, to close, what's the best way for someone to get a hold of you if they're interested in learning more about you and the things that you're doing to work with advisors?
So a couple of different ways. Obviously, they can find me on LinkedIn, but my website is all one word, Better Path as one word, and it's betterpathtraining.com. And they can find me up there. They can also find a podcast I've recently launched titled Financial Advisor Masterclass, which is a combination of a lot of training programs I've done, plus probably a couple thousand hours of FA coaching, all uploaded to an AI and then broken down into various topics, which is pretty remarkable. So what's up there is kind of composite wisdom, not just the baseline training, but the actual application of it. So they can find that out on the podcast as well. But betterpathtraining.com, they can find me there, or they can email me at my first name, last name, Gary.Sinderbrand@gmail.com or Gary@betterpathtraining.com.
Awesome.
They should be able to find me.
Awesome. Well, Gary, I really appreciate the extra time that we got to spend together today, because I think this is an important topic. Talking about succession is not just about the individual practices. It's about continuing to make and keep this business of being a financial advisor where it needs to be, because the work that financial advisors do is so important. So to the audience, thank you for listening. As always, we're rooting for your success, and we will see you next week.
Thanks for joining us for this episode of The Purpose-Focused Advisor. If you want to learn more, head over to our website, truestfancoaching.com. There you'll learn all about becoming a purpose-focused advisor. You'll also find today's show notes and links to the other gifts and resources we talked about during the episode. Again, thanks for listening, and remember, we're rooting for your success.